Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, April 14th, 2025. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is President Trump losing his own trade war? Our answers are, according to the White House, the exemption from the 145% China tariff and 10% global flat rate on consumer electronics is temporary and part of a longer-term plan, though the move signals President Trump's willingness to compromise, represents incremental confirmation of our view that the bond market activated the Trump put last week. China's consistently firm tone indicates that it believes that it has the upper hand in negotiations. At a minimum, President Xi's historic consolidation of power means that he will likely outlast President Trump's second term. At a maximum, China understands and can weaponize the fact that the other side of a trade war is a capital war and that the bloated U.S. public sector can ill afford to lose one. Elsewhere, Wall Street forecasts are finally starting to reflect the gravity of the economic headwinds implied by such extreme market volatility. While the decline in the U.S. dollar is supportive of their still sanguine outlooks, it is unlikely to fully offset the collection of headwinds that continue to be underappreciated by investors broadly. As such, we do not believe the net impact of tough comps, historically elevated policy uncertainty, tariffs, restricting immigration, and DOGE budget cuts is fully reflected in consensus GDP sales and earnings estimates. One right tail risk investors can hope for is more dysfunction in the U.S. Treasury market, because that will speed up the timing of the QE asset markets require from the Fed to truncate the global debt refinancing air pocket we've been presaging since last fall. The 42 Macro Global Liquidity Proxy currently indicates global liquidity is trending higher, up 5% on a month-over-month annualized basis and up 10% on a three-month annualized basis. The improvement in global investor balance sheet capacity is consistent with our message to clients from early March, specifically that the sharp decline in the U.S. dollar would be initially bearish for asset markets because it likely represents capital outflows from overowned U.S. assets, but also eventually bullish by flattering global liquidity. While it appears we have entered the latter, more constructive phase of the global liquidity cycle, key leading indicators suggest a modest downtrend in global liquidity over the medium term. We are not out of the liquidity woods yet. Transitioning to our 42 Macro dashboard, as always, a wrap up with a question from our community. This one's regarding twin deficits and global reserve currency. Says, hi, Darius. Are either or both deficits not a side effect to a nation's currency being the global reserve currency? Maybe I've misunderstood it or concluded it wrong in my memory, but I believe I've heard Lynn Alden explain something along those lines and about it being something like a Gordian knot trying to resolve this. What else comes to mind is that when there's a global liquidity crisis, the U.S. has to provide that liquidity somehow, right? Does that contribute to either of the deficits? I guess the crux of what I'm wondering is could the U.S. have avoided this deficit situation if it tried all of these years? Was this not something that comes along with just having the global reserve currency? So that's a phenomenal question. And I think that's a question that Stephen Moran, which is the White House, I want to say the chief economic advisor for the White House Council of Economic Advisors, that's one of the key questions he asked and tried to answer in his white paper last fall. I forget the name, now I'm blanking on the title. The role of the U.S. is, I don't even, it's the Hudson Bay Capital white paper from last fall. That kind of outlined several of the policy paths that the Trump administration are pursuing currently. So if you didn't know they were going to try to kitchen sink this thing, you just weren't paying attention. But anyway, that's neither here nor there. Getting back into this, so I'm not of the view that the U.S. this was an inevitable situation. U.S. fiscal policy is determined by Congress largely. Obviously, we have the elements of tariff policy that is determined by the president. Obviously, we've had this sort of in order for the world to grow with the U.S. dollar being the primary reserve currency, more importantly, the currency with which global trade and global finance is priced in, clearly you need to have a surplus of dollars flowing out into the world in order for the world to grow and have more dollars to invest, consume, and ultimately transact in capital and trade markets. And so that ultimately requires us to run persistent trade deficits. But I would argue our persistent trade deficits were a function of several things. One of those important things is the fact that we, the people who living here in the United States of America, have been very reluctant, if at all, to administer austerity at either the household level or at the federal, at the public sector level. We've consistently chosen to have more a lower net national savings rate, a lower household savings rate, and a lower net national savings rate because of our fiscal policy than we probably should have, which is creating a significant vulnerability in the Treasury market. Yes, it is true that being the reserve currency would have creates an incremental supply, incremental demand for the dollar that will prevent the dollar from sort of revaluing the way it normally would if in a kind of a standard textbook model on trade. If we continue to have persistent trade deficits, historically the dollar would revalue so that we can rebalance our demand, international demand, with our international exports. And the reality is we just have not done that. In part because there's been this persistent bid for dollars and dollar-denominated assets as a function of the way the global reserve currency, the global system has been set up, back in Bretton Woods in 1945. So this is something that has caused problems for us, but we've made those problems much, 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 much worse than they otherwise had to have been, or certainly would be at this particular juncture. Maybe they would have gotten here 20, 50, 30, 20, 30, 40, 50 years from now, but we got there to this point much sooner in terms of being very much on the hook to global capital flows as relates to our bond market being so. The loss of resiliency in the Treasury market now is a function of the fiscal largesse we've chosen. With these 7% budget deficits, GDP, our economic largesse that we've chosen. The U.S. consumer likes living high on the hog, likes using credit to finance layers of consumption that they otherwise wouldn't be able to with their income alone. And so these are choices we made because we've had the global reserve currency. We've taken advantage of the fact that we've had the global reserve currency, and now we're being taken advantage of in trade negotiations and so on and so forth. And obviously, we saw what happened in the bond market last week. Forced the Trump put to activate the Trump put. So, I said to our clients in our Around the Horn this weekend, I think last week was the most important week since Lehman Brothers. In terms of what it signaled for the potential loss, the beginning of the end of the U.S.'s exorbitant privilege and our global reserve currency status. The exorbitant privilege we've enjoyed as a function of our reserve currency status. I had one of our top clients emailed me the other in response to that. He said this wasn't the biggest week since Lehman Brothers; it was the biggest week since Bretton Woods. And I don't know if I disagree with that. I certainly don't. I'm more inclined to agree with him than I am to disagree with him. So I'll leave it at that. Darius down here wrapping up our macro minute, because this is some big stuff. I'm not going to be able to explain all this stuff in any individual macro minute. If you like us unpacking these types of dynamics with charts, with analysis, and ultimately with actionable investment conclusions, that's obviously reserved for our clients behind our paywall here. So wrapping up, Darius down here wrapping up our macro minute for Monday, April 14th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.